Welcome to Iron Financial, the forge for your portfolio. Today, we are cracking open the earnings report of a global titan, Brookfield Corporation. But we're not just going to skim the surface here. No, we are conducting a full structural analysis, stress testing this financial fortress from the foundation all the way up to see if it's built of solid steel or if it's just a facade. Our mission, as always, is to cut right through the market noise and figure out if this is a real opportunity to strengthen your position or a weakness you need to avoid at all costs. All right, let's get into it.
You see this sense right here, this quote from CEO Bruce Flatt? It's not just some soundbite he threw out on the latest earnings call. You have to understand this is the core philosophy. It's the entire DNA of this organization. Everything they do, every single asset they buy, every business they build, it's all designed around this one incredibly powerful principle. Find good businesses, run them well, and then just let the relentless power of compounding do all the heavy lifting for decades. Now, it's a simple promise for sure, but actually delivering on it, well, that's where the real work begins.
And this number, this is the result of that promise, 19%. That is Brookfield's annual compound return to its shareholders over the last 30 years. I want you to let that sink in for a moment. To put that into perspective, their CEO pointed out that if you had invested $1 million with them 3 decades ago, today it would be worth a staggering $285 million. That is not just a track record. That is the output of a wealth creation machine, an engine operating at absolute peak performance. It's a number that commands respect, and frankly, it demands a much, much closer look.
Okay, hold on. 19% for 30 years it's incredible, I'll give you that. But as we always say here at Iron Financial, past performance is absolutely no guarantee of future results. Is this amazing history really a blueprint for continued success? Or has the structure itself just become so vast, so incredibly complex, that it's now a house of cards waiting for a breeze? You know, our job today is to inspect the very foundation of this financial giant, to kick the tires and see if the engineering is actually sound enough for the next decade. The real question is this hype or is it real?
Right. And to do that properly, we need a plan. So here's our inspection agenda for today. First, we're going to examine the company's grand blueprint. Then we'll drill down into the 3 structural pillars that support the entire enterprise: asset management, wealth solutions, and their direct operating businesses. After that, we're going to actively search for any cracks in the armor by stress testing all the key risks. And finally, of course, we will deliver the Iron Financial verdict.
So, let's start with the overall design. What is Brookfield? Well, they define themselves as a leading global alternative asset manager. Their focus is on what they call real assets, the tangible, the essential things that form the absolute backbone of the global economy. We're talking about things like ports, pipelines, data centers, renewable power plants, and just critical infrastructure. Their stated goal, their primary directive, is to deliver 15% annualized returns over the long term by owning and operating these irreplaceable assets.
Now, here's what's so interesting about this slide. It shows the tangible output of that blueprint. This isn't some abstract goal they're hoping to hit. This is cold, hard cash flow. What we're looking at here is distributable earnings per share, which for our purposes is the cash they can actually return to shareholders. Just look at the powerful, consistent growth. It goes from $1.26 in 2021, climbing to $1.77 in 2023, and hitting a record $2.27 for the last 12 months. That's a double-digit increase year after year. This chart is basically the diagnostic readout of the engine, and it shows a machine that is running at full throttle.
Okay, let's move on to the first load-bearing pillar, their asset management business. I want you to think of this as the primary engine of the fortress. This is the part of the business where Brookfield raises massive pools of capital from institutions, like pension funds and sovereign wealth funds, and then invests it into their core strategies, generating enormous streams of fee revenue in the process. This right here is the heart of their fee-generating power.
And the power of that engine is it's staggering. In the last full year alone, the asset management division generated record distributable earnings of $2.8 billion. That's a single pillar contributing a massive portion of the company's total cash flow. This isn't some side business. It is a core driver of profitability for the entire enterprise, and its scale is a major competitive advantage. All right, let's pop the hood on this engine for a second. Look at these key performance indicators. Fee-bearing capital, that's the money they actively earn fees on, jumped 12% to over $600 billion. That growth directly fueled a 22% increase in fee-related earnings, hitting $3 billion. And look at the fuel they're adding to the tank. They raised another $112 billion of new capital just during the year. The scale we're talking about here is immense, and the growth, well, it's accelerating, not slowing down.
All right. The numbers are impressive, I get it. But the market is always looking forward. $600 billion is a ridiculously huge number. So how do you keep an engine that big growing at a meaningful clip? Is this kind of growth actually sustainable, or are they starting to hit the limits of their own scale? What specifically is going to fuel this engine in the coming years? A 12% growth rate on a base that large gets harder and harder and harder to achieve every single year.
Well, they have a pretty clear answer to that question. This is their roadmap. First, they have strong visibility on fundraising for their massive flagship funds in infrastructure and private equity. Second, they're tapping into the biggest trend on the planet right now with their new AI infrastructure fund. Think about it. They're not betting on which AI software wins. They're building the physical backbone, the data centers, the fiber optic networks, the power grids that the entire AI revolution absolutely requires. Third, the strategic acquisition of credit specialist Oaktree adds a whole other layer of expertise and opportunity. And underpinning all of this are these massive, multi-decade secular investment themes they're built around: digitalization, decarbonization, and deglobalization. These aren't fads. These are fundamental shifts in the global economy that will require trillions in investment for decades to come.
Hold on a minute. Management keeps talking about a huge pipeline of carried interest, or carry. Before we go any further, what does that actually mean? Break it down for us, because for anyone who isn't a professional fund manager, it just sounds like jargon. It's actually pretty simple. Carried interest is a performance fee. When Brookfield's funds perform well and generate profits above a certain threshold for their investors, Brookfield gets to keep a percentage of those profits, and that's typically around 20%. So the crucial point here is that it directly aligns their incentives with their clients. They only make the really serious money when their investors make serious money first. And this number brilliantly illustrates the sheer scale of their success. That number, $11.6 billion, is their accumulated, unrealized carried interest at the end of the year. This is a locked-in pipeline of future profit. It represents performance fees they have already earned on paper based on the current value of their investments, but they haven't yet converted it to cash. It's a massive, tangible indicator of future earnings power just sitting there, waiting to be harvested as they sell assets over the next several years. Think of it like a giant battery, fully charged and just ready to deploy. Okay, now let's examine the second pillar of the Brookfield empire, their wealth solutions business, which is primarily a rapidly growing insurance operation. If asset management is the engine that generates fees, I want you to think of this as the fortress, a massive strategic capital base that is becoming more and more important to the overall structure. This is where they are building a capital war chest. And this fortress is getting bigger, and it's getting bigger fast. As you can see from the breakdown, this division generated $1.7 billion in distributable earnings in the last year, a stunning 24% increase year over year. They sold $20 billion in annuities, bringing their total insurance asset base to a colossal $145 billion. And management's guidance is to hit $200 billion by the end of 2026. This is no longer a small, ancillary business. It's a core pillar, and it's firing on all cylinders. Okay, this is the part that really needs scrutiny. We all know insurance is typically a low-margin, capital-intensive business, right? You take in premiums, you pay out claims, and you just hope to make a tiny little spread. Yet Brookfield is targeting a mid-teens, 15% plus return on equity from this division. That seems almost impossibly high. So how are they pulling that off? What is the secret sauce that transforms a boring insurance business into a high-return compounding machine? There has to be an angle here. The secret, the angle, is a concept that is basically the holy grail for long-term investors. It's called insurance float. Here's how it works. When Brookfield sells an annuity, they receive a large sum of money up front, a premium. Now, they are obligated to pay that back over many, many years, but in the meantime, they get to hold and invest that capital. That massive pool of capital, the money they hold before paying claims, that is the float. The best analogy is this. It's like getting a giant, long-term loan from your customers at an extremely low, sometimes even negative interest rate. It's a vast, long duration, and very low-cost source of funding that's provided by their policyholders.
And this slide right here illustrates the absolute brilliance of their strategy. It's a powerful, self-reinforcing flywheel. So step 1, they acquire these long-duration liabilities like pensions and annuities, which brings in the cash. Step 2, that cash becomes the massive, low-cost insurance float we just talked about. Step 3, and this is the magic, this is the Brookfield advantage. They then deploy that float directly into their own best-in-class, high-yielding real asset strategies managed by their asset management pillar. The very same infrastructure, renewable, and credit funds we just discussed. And then step 4, they compound that capital at their target of 15% or more. They are literally using other people's money to fuel their own investment engine, creating this powerful, symbiotic relationship between their two largest businesses.
This brings us to the third and final pillar, the foundation upon which everything else is built, their operating businesses. This is where Brookfield isn't just managing money for others. This is the capital they own directly on their own balance sheet. These are the tangible, physical assets that they own and operate all across the globe. This is the bedrock of the entire corporation.
This picture of a GATX railcar, it perfectly captures the nature of this pillar. We are talking about durable, essential infrastructure that is absolutely critical to economic function. This portfolio includes things like renewable power facilities, critical transport networks like ports and rail lines, midstream energy pipelines, and data infrastructure. These businesses generated another $1.6 billion in distributable earnings last year, providing a stable, inflation-protected bedrock of cash flow for the entire corporation. Okay, look, real assets sound great in theory, but let's talk about the elephant in the room, commercial real estate. The headlines are screaming about empty office towers and a commercial real estate apocalypse, and Brookfield is one of the biggest office landlords in the world. They own all these trophy assets in major downtown cores. So isn't this a massive, undeniable crack in their foundation? You simply can't ignore the sentiment here.
You're right, that is the popular narrative, but the data from their earnings call tells a very, very different story. Let's look at the actual facts for their portfolio, not the market average. In the last year, they signed 17 million square feet of new office leases. The net rents they achieved on those leases were, on average, 18% higher than the leases that were expiring. And their highest quality Super Core and Core Plus portfolios are over 95% occupied. The takeaway here is pretty clear. While lower quality, the B and C class buildings are suffering badly, there is a major flight to quality. Tenant demand for premium, well-located real estate is actually growing, especially since new supply is extremely limited. For the best assets, the fundamentals are actually strengthening.
All right, the blueprint looks solid and the three pillars appear robust. I'll give you that. But every structure, it doesn't matter how well designed it is, it must be stress tested. So now we're going to put on our inspector hats and probe for potential cracks in the armor. Let's hit the key risks that analysts and the market are worried about. Rapid fire.
First up, this announced merger. Brookfield's plans to merge the parent corporation, BN, with its insurance arm, Brookfield Reinsurance, or BNT. Now they're selling this to everyone as simplification to make the company easier for investors to understand. But is simplification just Wall Street code for a move that could eliminate significant tax advantages that came with the separate structure? I mean, are they trading tax efficiency for just a simpler story?
That is exactly the risk that analysts hammered them on during the earnings call, and it's a completely valid concern. Management acknowledged it's a factor investors have to consider. Now, while they did state they are very focused on preserving all the operational and financial benefits, the risk is clear. The strategic rationale for this probably goes beyond just simplification. Combining these two entities creates a single, colossal balance sheet. It makes them an even more formidable capital powerhouse, maybe positioning them to compete more directly with giants like Berkshire Hathaway. But the execution is absolutely critical. Integrating these two colossal entities will be a massive undertaking, and navigating the complex tax implications without any value leakage, well, that's a significant execution risk.
Next, interest rates. It's the variable that has dominated markets for 2 years now. Everyone wants to know the sensitivity. We need a hard number. Specifically for their massive real estate portfolio where they carry a significant amount of debt, how much damage does a rise in interest rates actually do to their cash flow? Let's quantify the risk.
They provided the precise number on the call, and this is it. A 25 basis point or 0.25% change in interest rates has about a $35 million impact on their annual funds from operations, or FFO. Now, for a company that generated $5.4 billion in distributable earnings, $35 million, it's basically a rounding error. But it does give us a hard number to quantify the risk. It's not zero,
And in a volatile rate environment, it's a number that absolutely has to be monitored closely. It shows they are exposed, yes, but the exposure is manageable relative to their massive earnings base.
Okay, we've reviewed the blueprint, we have inspected the pillars, and we've run the stress tests. Now it's time to weigh all the evidence and deliver our final verdict. Is the market correctly pricing the strength of this financial fortress, or are there hidden weaknesses that make it a trap for unwary investors?
So here it is, the iron financial verdict, side by side. The case for this being a massive opportunity is incredibly compelling. You have a 30-year track record of 19% compound returns, which is almost unparalleled. You have 3 distinct, powerful, and growing earnings engines in asset management, insurance, and real assets. And their scale is a competitive moat. I mean, they can execute sophisticated, large-scale transactions that few others can even contemplate.
However, the case for it being a trap really centers on complexity and execution risk. Let's be honest, this is one of the most complex financial structures in the world, and that complexity can hide problems. The upcoming BNT merger adds a significant layer of integration risk, and they face fierce competition in every single one of their markets. In asset management, they're going up against Blackstone and KKR. In insurance, they're fighting for annuity business against giants like Apollo and all the established insurance players. There is no easy money here.
So the final analysis is this. Brookfield has, without a doubt, engineered a financial empire. It is a machine that has been meticulously designed for one single purpose, to compound capital over a very long-term horizon. Their strategy is sound, their execution has been world-class, and their scale is absolutely formidable. The ultimate question that every investor must ask themselves is the one right there on your screen. Is this a fortress truly built to last through any economic cycle, or has its sheer size and complexity made it a structure that has become, in its own way, too big to manage effectively? That is the final stress test you must run before you even think about forging this name into your portfolio.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.